This is BD Daily Finance News Podcast, daily insights on markets, economy, and investing. I'm your host, and today is 2025, December 8th. Welcome to the Beyond Daily Finance Show.
And I'm your guest. We take the finance headlines, squeeze out the jargon, and leave you with something you can actually use before your coffee gets cold.
Today, we've got four big stories. The Fed is lining up another rate cut. Regulators are warning that gold and U.S. stocks look bubbly. IBM is dropping $11 billion on Confluent. And there's a simple one-year move some strategists say could beat inflation.
So we're doing central banks, bubbles, big tech, and a cheat code for your savings. Basically, the financial version of a tasting menu, but with less foam and more numbers.
Let's start with the main course, the Federal Reserve. This week's meeting is expected to bring a third rate cut in a row, and markets are betting it will keep the soft landing story alive without tipping us into a recession.
Every time the Fed meets, people act like it's the series finale of the economy. Can you break down what's actually on the table this week in human language?
In simple terms, the Fed is widely expected to cut interest rates again, the third straight meeting with a cut. They're trying to cool inflation that's come down from its peak without slamming the brakes so hard that unemployment spikes and growth stalls.
So it's like driving downhill with one foot on the brake and one foot on the gas and hoping the car doesn't spin out or catch fire. What are markets obsessing over this time?
Two things. First, how big this cut is and what they signal for early 2026. Second, the Fed's updated economic projections, especially how many total cuts they see over the next couple of years. Those dots on the so-called dot plot can move stocks, bonds, and the U.S. dollar in minutes.
The dot plot is my favorite thing. It's like a horoscope for interest rates, except instead of "you will meet a tall stranger," it's "you will maybe get a cheaper mortgage if the economy behaves."
For regular people, rate cuts filter into three big areas. Borrowing gets cheaper over time, so think mortgages, car loans, and credit cards. Savings accounts and money market yields drift down. And risk assets like stocks often get support because future earnings are discounted at lower rates.
Your credit card might hurt a tiny bit less, your savings account might pay you a tiny bit less, and your stock portfolio might look a tiny bit happier. Very tiny energy all around.
Exactly. But the bigger issue is whether the Fed can cut enough to support growth without reigniting inflation. Markets are almost begging for a Goldilocks outcome. Slower but steady growth, inflation drifting toward 2%, and no sudden shock in jobs data.
If they mess it up, what's the risk? More recession, or more inflation, or just more angry tweets?
If they cut too aggressively, inflation could re-accelerate, and long-term bond yields could jump as investors demand compensation. If they're too cautious, growth could stall, hiring could slow, and risk assets might reprice lower. Either way, volatility tends to spike around these meetings.
So for someone listening with a 401k and a normal job, the move this week is not to YOLO everything before the announcement, right?
Right. The practical move is boring. Stay diversified, avoid big portfolio changes right before the meeting, and pay attention to how your adjustable rate debt or upcoming home purchase might be affected over the next 6 to 12 months, not just this week.
Okay, so that's the Fed trying to land the plane. Let's talk about the passengers in first class popping champagne. We've got a warning that gold and U.S. stocks are in bubble territory, right?
Yes. A report warns that retail investors have helped drive gold and U.S. stocks into what looks like bubble territory. They describe explosive price gains and compare current patterns to previous asset bubbles.
Every time I hear retail investors, I picture a Reddit thread in a Viking helmet. What are they actually seeing in the data that screams bubble?
They're looking at very fast price gains, stretched valuations, and a big surge in small investors piling into popular trades. Gold has surged as people hedge against inflation and geopolitical risk. U.S. stocks, especially big indices, are hitting repeated highs despite slowing growth in some parts of the economy.
So it's like a house party that started as a chill hang, and now there are 200 people, 3 DJs, and someone is grilling in the living room. Nothing has broken yet, but you can feel it coming.
Exactly. Bubbles are usually about expectations more than fundamentals. When people start buying just because prices are going up, not because they've done the math, risk climbs. The report notes that retail flows are a bigger driver this time, similar to meme stock waves.
Let's do the simple version. If I'm that person who bought gold because my uncle at Thanksgiving said everything's going to collapse, what's the actual risk here?
The risk is that if sentiment flips, prices can fall much faster than they rose. In a bubble, when everyone rushes for the exit, liquidity dries up and you can see sharp drawdowns. That's true for speculative tech stocks, but also for supposedly safe assets like gold when they get crowded.
So how do you know if you're investing versus just gambling with a fancier app interface?
A quick gut check. If you can explain in 1 or 2 sentences why you own something, including what might make you sell, you're investing. If your thesis is just, "it keeps going up," you're speculating. In a bubble warning environment, that difference matters a lot.
What's the practical move then? Do people dump their gold, sell all their U.S. stocks, and move into canned beans and cash under the mattress?
No mattress strategy. The move is to check concentration risk. If gold or a handful of hot U.S. stocks are more than, say, 10 to 20% of your net worth, consider trimming and rebalancing. Use diversification, not drama, as your risk management tool.
So basically, don't be the last one at the party trying to call an Uber when your phone's at 1%. Have an exit plan before things get weird.
Let's pivot to big tech. IBM just announced an $11 billion deal to acquire Confluent, a data streaming company. It's their biggest deal since 2019 and a direct play on the data infrastructure needed to power AI.
Data streaming sounds like something I do when I leave Netflix running in the background. What does Confluent actually do in money terms?
Think of Confluent as plumbing for real-time data. It helps companies move and process streams of information, transactions, sensor data, user activity, instantly, instead of dumping it into a database and checking later. For AI, that real-time flow is crucial for training models and powering applications.
So if data is the new oil, Confluent is like the pipeline network, and IBM is saying, we're tired of just selling gas stations, we want the pipes too. Why spend $11 billion now?
Because AI spending is exploding, and the winners won't just be flashy model builders. There's a pick and shovel trade here, selling the infrastructure everyone needs. IBM is betting that as companies modernize their data stacks for AI, they'll pay up for integrated solutions that combine cloud, consulting, and data streaming.
For workers and investors, what does this signal? Is this just another big tech headline, or does it actually touch normal people?
It matters in 3 ways. Jobs. Demand for data engineers, cloud architects, and AI ops roles keeps rising. Products. More real-time personalization and automation in everyday apps. Portfolios. It reinforces the theme that infrastructure providers in AI, chips, power, networking, data streaming may be more stable plays than pure AI hype names.
So if I'm picking investments, it's not just which chatbot is sassiest, it's who's selling the shovels, the wires, and apparently the data plumbing behind it.
Exactly. Without naming specific stocks, the takeaway is to look across the AI stack. Chips, power, data centers, and now data streaming are all critical layers. A balanced AI strategy doesn't just chase the headline names. It includes these quieter infrastructure plays.
And if you work in tech and your job title includes the word data anywhere, this is another sign your skills are in demand. Update that LinkedIn before IBM finishes the paperwork.
Speaking of paperwork, let's talk about a very unsexy but powerful idea, one-year Treasury bills. Some strategists argue that with short-term interest rates still high, one-year Treasuries are a rare chance to beat inflation with relatively low risk.
This is the part where people's eyes glaze over. So let's slow it down. What is a one-year Treasury bill in plain English?
It's basically a one-year IOU from the U.S. government. You lend the government money today, they pay you back in a year with a set return. Right now, those yields are still elevated because the Fed held rates high to fight inflation.
So it's like giving money to the most boring friend you have, who absolutely will pay you back in exactly 1 year with a little extra. Why is this suddenly interesting?
Because short-term rates are high relative to expected inflation. If inflation over the next year ends up lower than the yield on those treasuries, your real return, after inflation, is positive. That's what people mean by beating inflation in this context.
And the article basically says short-term interest rates are too high for where the economy is heading, so lock them in before the Fed keeps cutting, right?
That's the argument. If the Fed keeps trimming rates into 2026, yields on new one-year treasuries and savings products will likely drift lower. Buying now lets you capture today's higher rate for the next 12 months with the backing of the U.S. government.
Who is this actually good for? Because not everyone listening has spare cash sitting around in a Swiss-level emergency fund.
It's most interesting if you have cash beyond your emergency fund that you don't need for at least a year. Instead of leaving it in a low-yield checking account, one-year treasuries or treasury-focused money market funds can give you higher, relatively safe income.
And how do you not mess this up? Because the phrase Treasury ladder already sounds like a way to fall off something.
Simple guardrails. 1. Don't use money you may need in the next few months. 2. Understand that if you buy bond funds instead of individual treasuries, prices can move with rates. And 3. Keep it as part of a broader plan, not your whole strategy.
So we've got the Fed maybe cutting, bubbles possibly forming, IBM buying data plumbing, and one-year treasuries quietly trying to be the adult in the room. Can you recap the main moves for listeners?
1. Don't overreact to this week's Fed meeting. Think in 6 to 12-month terms for your debt and investments. 2. Treat gold and hot U.S. stocks with respect. Rebalance if they've grown too big. 3. See IBM's Confluent deal as a reminder that AI infrastructure is a real, long-term theme. 4. Consider whether one-year treasuries fit into your plan as a way to earn real income while rates are still elevated.
And as always, this is education, not personalized advice. Talk to a professional before you move big chunks of money, especially if your current strategy is just, I hope the Fed likes me.
If you found this helpful, follow the show, share it with a friend who's worried about bubbles, and leave a comment with the one money question you want answered before the end of the year.
You've been listening to BD Daily Finance News Podcast, the Beyond Daily Finance Show. We'll be back tomorrow to translate more chaos into something your budget can understand.